Let's take stock of banks. My next guest says that Citigroup cast a dark cloud over its shareholders by deciding to sell stock in order to repay TARP. This while the government still owns a very big piece of the Citigroup pie. Well, what should Citigroup have done? Joining me, Chris Kotowski, Managing Director, Senior Banking Analyst at Oppenheimer Co. Chris, good to have you with us. Thanks so much for coming in.
Thank you for having me.
So you think this was a lousy move?
Well, I don't think it was discretionary on Citibank's part. I think the problem was really that the government, which had ample opportunity to sell its shares at much higher levels in the fall, didn't clear that overhang out first. And because as long as the government owns a third of the stock, which is effectively what they did, it's going to limit the shareholder base that Citibank can appeal to. So the government insisted really that Citibank first clear out the TARP and then that they'd sell their shares. And that's just very unappealing it's just structurally unappealing to most investors out there. You know, why buy in front of an offering when you know that the government is still going to be in control of it? And then, by the way, after you've bought the stock, then the government is going to dump their 7.7 billion shares.
This seems relatively straightforward. Was this not something that you think the government considered?
I can't imagine why the government chose to do it this way. I mean, if you look in September, August, and November, we calculate that roughly 38 billion shares of Citibank stock traded at over $4 a share. So that would have given the government plenty of time to sell the stock in an orderly manner. And in fact, two other sovereign entities, the Kuwaiti Investment Authority and the GIC, they both sold over 1 billion shares and had a nice multi-billion-dollar profit for their investors. But for some reason, I'm not sure why. You should ask them. But
so did Uncle Sam shoot themselves in the foot?
Well, I mean, we had plenty of time to sell stock at a nice big profit. The taxpayers would have benefited. And quite honestly, it would have helped Citibank out a lot. It would have been good for everyone because it would have let the government say, hey, we have a profit in this investment. We did well by the taxpayers. And it would have let Citibank in the fall say, see, we're starting the process towards privatization. We're making progress. You know, you should. It would have made it much easier for Citibank to attract private capital. They were really painted in a corner. It was not a discretionary offering. They had to do this, and they had to do it 2 weeks before Christmas, more or less with a gun to their head. So this is not something I fault Citibank management for. I think they were put into an impossible situation.
So this is a lose-lose situation? No one walks away with a pony?
This was a lose-lose. I'm firmly of the opinion that if we had taken the chance to scale out of the stock, and it wouldn't have had to be all done at one shot, but the government could easily have sold, say, $5 to $10 billion in 2 or 3 block trades during the course of the fall, and the market would have cheered, investors would have scooped it up. I'm absolutely convinced of that. All the investors I was talking to were looking for it, and everyone was always stunned when it never came.
So what's the possibility of the government getting out of its stake that it still has in Citigroup with anything like a profit?
Well, quite honestly, I think you'll get out of it at a profit. I think the shares are oversold. Tangible book after this is all done, tangible book will be around $4 a share, and the stock's trading at $3.20. It's a much too big discount, and I'm pretty confident it'll trade back up to that. The shame of it is, though, that now tangible book is probably the cap in the stock that the taxpayers are going to receive, whereas if they'd sold it in the fall, it would have probably been the floor.
So it seems as though like tangible cap is out of the bag almost, right? It's the big poster child.
Well, tangible book value is what we look at because that's theoretically what you would get. If you just sold off all the assets and paid off all the liabilities, you'd be left with a $4 a share pile of cash at the end of the day. That's why we look at it as an analytical tool.
All right. I want to thank you very much, Chris Kotowski, coming to us from Oppenheimer, sharing your thoughts about a strange situation, the share sale at Citigroup. Thanks very much.